All right, everyone. Welcome to the Rise Seattle Group quick mortgage interest rate sync, market sync. We're very excited to actually have our good friend Rob Berg, who many of you have used. He's one of our preferred lenders, and we're going to get to Rob here in just a minute. But the reason we're here, the reason we're actually having this conversation is because a lot of our clients are really confused. We keep getting questions like, is it the right time to buy? Is it the right time to sell? If I actually purchase something right now, am I setting myself up for catastrophe as we enter into what looks more and more like a recession that is coming? And typically when fear, uncertainty, and doubt, or FUD, if you will, as they use in the tech world, happens, we tend to freeze, right? We tend to have this situation where we pause and we hold and we just kind of sit. And that can be a wise decision, but it also can be an opportunity. There could be a missed opportunity if the goal at the end of the day is either to buy or the goal is ultimately to sell. And so that's the reason we're here today. That's the reason we're having this conversation. So we wanted to invite one of our trusted friends and advisors and mortgage brokers into the mix of this. So hopefully that we can move forward, create more clarity, and give you the listener and of this episode, give you an opportunity to understand and have clarity as you move forward into your next decision. So, Rob Berg, thank you for joining us. Rob is a mortgage broker, loan officer with Fairway Independent Mortgage. He's also a certified CPA. And for purposes that we don't want to get sued, that is NMLS number 111432. All right, check that box. He is licensed in Washington, Oregon, Montana, Idaho, Arizona, California, Colorado, and Florida. So he's not just licensed here in Washington State. If you're looking to purchase investment property in Florida or something in Idaho, he can do that for you, which is great. So, Rob, thank you for being here. Thanks for giving us the time, and we're just looking forward to chatting with you. So, okay. So, Rob, now we have some questions. Like I said, we're trying to create clarity for folks. My first question is just going to be, what are interest rates? Like we keep talking about the federal funds rate, and we're also talking about mortgage interest rates. Let's start just real quick. What's the federal funds rate? And then we'll kind of go from there.
Yeah. So the Fed funds rate is a short-term lending rate that is used for banks, basically and it's an overnight lending rate. And so the Fed uses this interest rate to either make money more available and therefore kind of stimulate the economy, or in order to slow down the economy, they will increase that interest rate. And so right now, we've seen the Fed, they've really increased interest rates significantly over the last year. And the idea behind that is they were feeling that the economy was heating up too much and it wasn't going to be good for the economy. So they raised that interest rate. And what that does is it really slows down investment by businesses specifically. And that's where the majority of the money is spent. And so if the cost of a business's money is increasing significantly, they're going to be less likely to do big plant expansions. They're going to be less likely to spend more money. How we as consumers feel that, though, would be in the form of credit card interest rates, right? It's really short term in nature. So credit card interest rates, auto loans, things of that nature. So you'll see any kind of short term interest rates have increased significantly. And that's kind of why they use that, right? So they're slowing down the economy purposefully to try to just kind of slow down things and kind of keep us in a healthy spot in the economy.
So conventional wisdom tells me if I'm, following the Dave Ramsey route, if you will, if I'm paying to zero on my credit card or not even using a credit card, or I'm buying a car for cash and not getting an actual lease on a car, that's actually pretty strategic, and you can set yourself up where you're not as impacted by this individually. Obviously, the cost, and we can get into inflation in a minute, cost is going up, but that is a way that you can kind of set yourself up for success and not be as impacted by these rates, correct?
Correct. Yeah, for sure.
Okay.
I think the So if you are someone who carries a low debt burden, right? Not auto loans, you don't have credit card debt, you're really not impacted, at least by the Fed's movement of interest rates.
Sure.
And there's a big difference there between, a lot of clients confuse, oh man, I heard that the Fed raised the rates again. And now 30-year fixed rates are going to go up as well. And there's a big difference there between the two.
What is that difference?
So the underlying concern for people that hold any type of debt, so it could be a treasury note, or a mortgage, or something that has a long duration, right? Like you're going to hold it for 10 years or 20 years or 30 years. Your biggest concern as an investor in that kind of instrument is, well, what is happening in the economy, and is my money being eroded, right? So the idea about inflation is too many, I guess the definition would be too many people, or too much money chasing too few goods, right? So all of a sudden you have the cost of something that's getting more expensive and more expensive. And the Fed, their goal is to kind of have this inflation target where every year things get more expensive by about 2%. And so anytime we start seeing inflation get more expensive, where all of a sudden it's 5, 6, 7, 8%, the government gets concerned, and the Fed gets involved. And the Fed, in order to once again slow down, the economy, and kind of like get that inflation target back to the levels they want to be at, they will raise that Fed funds rate. Well, what happens is all of a sudden that money gets expensive, people stop investing, and it puts our country into a recession, where all of a sudden, we're not creating as many goods and services as we had been creating. And so in a recessionary situation, I guess, if you think about it, what do most people do when there's a recession or when things are uncertain? They look for safety, right? So the goal of the Fed is pushing these short-term rates up, making things more expensive for investment, and therefore then it will slow things down. And so when things get worse, big companies, hedge funds, retirement accounts, they will then move their money from more risky investments into safer investments. And so there's a lot of talk right now about interest rates dropping throughout the year. And that is the fundamental reason, is the Fed is forcing us into a recession, which we're probably in one now, or we will be shortly. And when that happens, you'll see a lot of money shift from stock market into more safe investments, right? Because it's uncertain times. And when that happens, you have a lot of people that are going after these certain short-term or more safer investments, a lot more demand for that. And therefore, those interest rates start falling. And that is kind of the relation there.
So help us divide for us the difference between the Fed rate and mortgage interest rates, because that's what a lot of people that we're working with right now are thinking about too. They still want to buy a home, but they have some fear, they have some uncertainty. They're worried about the future. Should we buy now, or should we wait 3 months or 6 months? Will the market change? So the Fed fund rate is one thing, but mortgage interest rates are something else. Tell us how those are set, and how we should be thinking about those moving into this probably recessionary market that we're going into.
Yeah. So if you think of yourself as an investor, right? You're like, hey, I have this money I want to invest. When it comes to a mortgage interest rate, the question is like, what's determining that fundamental rate? And so if you look at an investor says, hey, I want to make 2%, right, on my money. If inflation is 5%, then you need to literally take inflation rate plus your return. So now you need a 7% return to actually make 2%, because 5% is being lost from inflation. So as this inflation, level decreases, interest rates will follow. So now the Fed has done their job, pushed interest rates high. All of a sudden, you'll see the inflation is going to start dropping. And we've already seen signs of this. I took a couple of notes here, but if you look at the cost that there's something called the producer price index. That has dropped in the last year from 11.7% down to 2.3%. The consumer price index has dropped from 9.1 down to 4.9. So all of a sudden, that's 5% drop. And what we're going to see is inflation continue to drop. And so what you're going to see as a consumer is long-term 30-year fixed rates will continue to drop as this inflation, component drops as well. So you're going to see, oh, go ahead.
Those are in sync with each other often, then?
They are. Yeah, literally if you think from an investor standpoint, take inflation plus your return you want to make, and that's what the 30-year fixed rate should be.
Okay.
So as inflation drops, you will then therefore see interest rates, mortgage rates drop as well.
Okay.
And my expectation is that we're going to see a significant drop. There's different components of the CPI index, et cetera, that are kind of lagging, and you can literally like look at how it's calculated and see that we are going to start seeing this drop in interest rates pretty consistently throughout the rest of the year. And
Gotcha.
A lot of people had heard this May 10th date where they were expecting this big drop. And we saw a little bit of a drop, but a lot of people were saying this is going to be the beginning where we'll start seeing rates consistently drop from May 10th throughout the rest of the year. Not that we were going to have this massive drop on that date, but that was the date where moving forward, we should consistently see rates dropping.
When you're talking specifically about what investors are tracking is inflation plus your return, and that's how they're calculating it. So as inflation comes down, then basically interest rates come down. That's actually super helpful to be able to give a visual. Is that what the 10-year treasury yield is? What is the 10-year treasury yield?
The 10-year treasury yield, and so a lot of people, it's a readily available number. So a lot of people refer to that and say, hey, I can just look at that and see kind of where interest rates are. But the 10-year treasury yield, or the 10-year treasury note, is kind of the closest note that's, I guess, issued by the government that tracks the 30-year fixed mortgage as close as possible. That's not a very good way of saying it. Let me rephrase that. So if you think about what it actually is, the government is raising money by issuing a 10-year treasury note, right? The difference between a treasury note and a mortgage is that there's two things. One, there's no default risk, right? If I get a mortgage and I don't make my payments, that investor is not going to receive the money. That's not an issue with the government, right? Because the government can just issue money. Not that we like them to do that, but they can to make sure that they're paying their debts. That's the first thing. The second thing is that there's also prepayment risk with a mortgage. So if I give someone a mortgage today at 7% or 6% and rates drop to 4% next year and the client gets a new mortgage, I no longer have my 6% return. I got paid off. That doesn't happen with a treasury note, right? The government is going to pay for 10 years. So it's a risk-free loan. I guess there's for an investor, right? There's no prepayment risk. You're going to get that return, and they're not going to default. So that's like what it fundamentally is. The reason it's a important piece when it comes to mortgages and the 10-year treasury is that the average mortgage is paid off between 6 and 7 years. It's the closest duration or time period of something that the government issues that tracks as close as possible to a mortgage. And that's why people refer to that a lot, because once again, it's the risk-free. When I talk about like, okay, well, it's a risk-free, there's no risk on it. So you take that plus then the investor's return they need to make, right? That kind of also helps track and show you where mortgage rates are likely to go. And there's a typical spread there, 1.75 to 2%, that mortgage rates are above a treasury historically.
Okay.
Does that make sense?
And what are they at above right now? Because it's higher, correct, or no?
Yeah, it's almost 3%. And the reason it's 3% is that, I mentioned that prepayment risk, right? Like a mortgage get prepaid if rates drop. The entire market is forecasting that rates are dropping. When I say the entire market, it's not just like the mortgage industry. It's National Association of Realtors, Fannie Mae, Freddie Mac, Wall Street, hedge funds. Everybody's saying rates are going to drop. And so that spread is now 3% instead of the historical 1.75 to 2%. And so because it's a bigger spread, the reason is because they know it's going to get paid off really quickly. So all of Wall Street, all of the financial world is saying with certainty, this is going to happen.
So let's talk about that. Like, what is the time frame? Like May 10th is here, obviously. Yep. And I know that was a big date for a lot of people. So when you think about the next several months to 6 to 12 months, what do you see? What are you thinking about in that sense then? And where are these rates going to go? And is that difference going to lessen? Is it going to go back to 1.75? Is it going to go back to 2%? You know,
Yeah. So I'll get my crystal ball out. So once again,
I'll hold you to.
yeah, okay, perfect. As long as you hold me to it. So if I kind of paint my scenario of what I'm expecting for like the next 6 to 12 months, I'm expecting that we're going to see interest rates drop probably 0.5% in the next 2 months, like by early midsummer.
Okay.
Because we're going to start seeing this drop, and I think there's going to be a lot of movement. Wall Street tends to move things, too far one direction, then overcorrect, etc. So I think we're going to see rates drop about 0.5% in the next, say, 3 months. And then I think it'll be a slow trickle from there. I think by the end of the year, we're going to be right around 5%, somewhere in that range. And I think it's going to be, and I think it just makes sense. And I don't think we're going to see that spread though. You mentioned that extra 1% that's built in because of this prepayment concern. I don't think we're going to see that removed until probably like next year, right? As rates are trending lower, the likelihood for early payoffs is going to continue. It's going to still be there, right? So I think until we kind of level off for a period of 6 months or so, that you'll still have that extra spread built in there. But I do think rates around 5%.
So then once we see that, then we'd see rates drop even more because that spread would drop, right? So investors would accept a smaller spread, and then you'd see. So do you think by 24 we'd see? You're saying 5%, but do you think after that there's room beneath that, or does that 5% account for the the lessening of the margin between the?
I think we're going to see rates next year in the low to mid 4s. Wow. Is my guess.
That's great.
And once again, I mean, yes, I can say that all day. Who knows what's going to happen? But I would just say that based on all the numbers that we're looking at, I think that seems reasonable to me. And in a year, if you pull this up and we're not there, I'll be a little sheepish. But I would say, you had mentioned earlier the question about like how should clients be looking at this current market, right? That's the big question. If I'm a consumer, we have this data. How do I actually like take advantage of the situation, or what's my best move? And when I'm talking to clients, I hesitate to say, if I were you, I would look to buy as soon as possible. And the reason is I don't want to put this, pressure on somebody to try to do something sooner than what they would otherwise likely feel comfortable doing. So we don't want to force people into doing things faster than where they feel comfortable. However, what we've historically seen is that 8 of the 9 recessions of the last 80 years, in 8 of the 9 recessions, we've seen housing prices increase. And the reason for that is that as rates drop, what do most people do? They say, hey, now is a great time to buy. So this drop in interest rates that we're going to see, and hopefully we get the mid 4s, like I said, or low 4s. But if we don't, right, we're still going to see rates dropping, and it's going to bring more people into the market. And that is going to cause house prices to continue to increase. And it might not be at some crazy level like we saw 2 years ago. However, the benefit of buyers right now is they can actually potentially negotiate on a house, or they can move at a pace where they feel comfortable, right? Yeah. First-time home buyers 2 years ago were forced into making fast decisions, giving up rights that they otherwise would have had. And you kind of have to throw everything at a possible purchase. And you're kind of moving at such a fast clip, it just doesn't feel comfortable for anybody. Me or agents, you guys as well, probably. It's like, this is so crazy. And I think we're going to see that kind of happen again.
So Rob, if I'm taking what you're saying as likely to happen, and I think, well, now's then maybe a good time to buy because there is some room to negotiate on some of these offers, not all of them.
Yeah.
And I'm going to take the chance that rates are going to come down. How long before if I bought in June, when could I refinance? Let's say rates do by December come down to a 5 or something like that, where I'm like, oh, if I could lock that in long term, how long do I have to wait to take advantage of so that I could at least take a calculated risk and say, I'll buy where rates are now, hoping that, trusting that in how much time before I can refinance into something more permanent for myself?
Yeah, typically 6 months is our goal, is that clients would wait 6 months. And the reason for the 6 months, it's not a hard and fast rule. I mean, a client is able to do anything they want at any time.
Okay.
But all lenders, all banks will say that there's a 6-month rule, just as like a gentleman's agreement. And the reason is because these companies, we originate these mortgages, and a lot of the investors we work with we have agreements with them that they're going to have the loan for at least 6 months. If it's paid off faster than 6 months, then our company gets hit with a pretty big penalty. And that's the reason for the 6 months. But the client, it's actually their option to do anything they want anytime after closing. But I just try to say, hey, if you can wait 6 months, it'd really help everybody out here, just so we don't get hit with big penalties. But they literally are free to do what they want whenever they want.
Yeah. Well, it's super helpful, Rob, just because like when I'm looking at or what we have noticed is as soon as interest rates get it below 6%, it's
Yeah,
automatically multiple offers. Like
sure.
it has been so wild to watch as interest rates dip below 6%, and all of a sudden it's like, all right, buckle up, here we are again. And we're
Yeah,
already in this historically low inventory market. So if you and that inventory, I don't know how it gets freed up necessarily. Cause like for me, I have a 2.5% interest rate on my house that I bought in 2015. It's going to make a great rental. There's no
sure,
reason for me to sell that if I don't need to, right? If I need to, obviously there's a reason. But for me, I'm going to hold on to that. And I know there's so many other Americans across the country who are in that exact same space. There's also people who are holding on to a 2.5% interest rate who maybe they want to move up, maybe they want to move down, but they're on a 2.5% interest rate. They don't even blink at their mortgage and they feel really content, plus institutional investors, plus Airbnbs. So all
sure,
this inventory has been completely taken away. And we're in this restricted inventory market when we should be technically in a high inventory market because of these high interest rates. What's going to happen once those interest rates go down, let's say to 5% or even low 4%? All the inventory gets sucked up, and now we're in this competitive situation again. It's not like I don't want that to be the case. It's just what seems to be the trend when
sure.
interest rates come back down. So I couldn't agree more. I'm drinking my own medicine, taking my own advice, and bought a house in January, and it's already gone up, quite a bit, just
Sure.
because inventory levels have come down and interest rates have kind of come down a little bit. So I really appreciate you giving us that context and that visual, because I do think it's very helpful for people to be able to make a decision and go, I heard somebody say this is your temporary mortgage. This isn't your your
Yeah,
long-term
yeah,
mortgage. It's a temporary mortgage. And like if you see it from that perspective and you run the numbers, you actually net out way better. And you're also trading momentary anxiety of buying maybe in a recessionary market for having to compete and waive everything in a really competitive market. So both are anxious situations, both are stressful
sure.
situations. It's just, what do you want? Which one would you prefer to have? Would you rather have waive everything and have no rights and
Yeah,
throw, 200 grand over asking price at something, which is still happening in this current market, by the way.
totally.
Um,
Yeah,
you know, so that's super helpful.
Fortune favors the bold.
It does, right? Well, you go back to what Buffett said, right? Get greedy when others are fearful, and fearful when others are greedy. And there is really something to that. It takes courage to do that. Like I've had several sleepless nights in doing this, but I'm watching my equity grow because we took that risk. And that's what we want to encourage our clients to do if they have the courage and strength to do that.
well, the one other thing I was going to say, just to piggyback off that, is, I mean, yes, I think naturally as humans, we look back and we say, we remember these really fearful, scary times, right? Think about 2008 and 9. Like that was scary for the entire nation, like a lot of fear at that time. And we kind of go back to that, like, oh my gosh, is that going to happen again? And I think, if you look back the last 81 years of housing, 73 of 81 years we've had appreciation. But yet, most of us remember like 2008 is a big scary thing, but I mean literally 90% of years for the last 81 years we've had appreciation. So I can't really find a better time to buy. If you're looking to buy, at least from my perspective, in the next few years, I would personally look to do it sooner rather than later. So.
Yeah. Well, any other questions from our group, or any last minute, one more nugget or anything from you, Rob? We good?
Michael,
I think we're
Lisa,
good.
you guys are good?
Super
Yeah.
helpful.
It's definitely an
Well,
interesting
actually,
time. Oh, go ahead. Michael, you're up.
well, if I may, this has been a question that I have received from multiple buyers in the past, and maybe it has been more pertinent at the beginning of these interest rate increases. But a lot of people have been asking about ARMs, adjustable rate mortgages. And my question is like, when are these products applicable? In what markets is it beneficial to have an ARM? And when is a strategic time to use these products over something like a 30-year fixed mortgage?
Yeah. So, how earlier I mentioned the Fed has pushed interest rates up significantly, like 5.5% in the last year. And the Fed funds rate is directly attributable to short-term debt, right? Credit cards, auto loans, etc. Things that are like 5 years or shorter in duration. And ARMs, right, adjusted rate mortgages, they have their place. But right now, at least from the options we have, ARMs are actually more expensive than a 30-year fixed is. So the time in which we see adjusted rate mortgages being aggressively priced will be once rates drop. So when we see rates down like in the mid fours again, then you will see significant benefits taking adjusted rate mortgage. And the idea, right, is if you can have your money locked up, your rate locked up for 5 years instead of 30 years, but maybe I'm going to sell the house in 3 years, so I only need 5 years of security, right? So I don't need a 30-year mortgage. I just need 3 to 5 years covered. Well, historically, you get about a 1% reduction in your interest rate by taking a 5-year ARM over a 30-year fix. So at that point, right, it would make sense. But in the current market, from what we're seeing, there isn't any benefit to taking an adjusted rate mortgage. So if it were me, I would just default to a 30-year fix now. And then when rates do drop, at that point, look and say, does an ARM better suit my needs going forward?
That's great.
That helpful? Okay.
Yeah. Lisa, anything on your end, Lisa, before we wrap?
No, this has been super helpful. Thanks, Rob.
Yeah,
Cool.
for sure.
All right. Well, Rob, where can people find you? Where's the best way for them to reach you?
Well, you could literally, what I tell everyone, just Google my name, Rob Berg, B-E-R-G.
Sure.
I mean, I could send you to a website, I can send you different places, but if you just Google me, you'll find me everywhere. We have lots of good reviews out there. Been doing this a long time, since 2004, and I love it. I mean, I tell everybody, most people say, do you like your job? Expect me to say no. And I really do just love it. I love like the education piece. I love just the fact that it gives me flexibility, but I really do love talking about this, as you can probably tell. I know we're targeting maybe 10 minutes and who knows where we're at now, but yeah, I really love it. So I just tell everybody, feel free to call with any and all questions, and I'm more than happy to chat through anything.
I love it. Well, to give a personal testimony to Rob, he is one of my preferred lenders. We send him to every single buyer we sit down with, and yeah, I just can't speak higher of you. So much so that when I even went to buy an investment property at the time in the middle of COVID, Rob was like, "I don't have the best rates. You should probably go. Here's my buddy over at Wells Fargo." And so, Rob is the type of person who wants you to win rather than him to get a deal. And he's somebody I trust and am calling often, and have even, been in a couple of situations where I'm just like frantically calling him, trying to figure it out, even though he wasn't connected to the deal. So thank you, Rob. Thanks for just being a friend, for being an advocate and an advisor, and pouring that passion into your job, because it really does show. So, and thank you, the Rise team, and all of our client base, everyone who's just watching this and trying to just learn, and as we're navigating a very volatile and strange market. So looking forward to bringing you more things like this in the future, and we hope you have a great day and enjoy some of that sunshine. All right, talk to you soon. And let me get the recording. Sorry, it's still recording.